All right, today we're talking about variable universal life, how exactly it's invested in the stock market, and the pros and cons to the policy. Alright, so if you already watched my video on Index Universal Life, I think you'll like this one too. This one's even simpler. We're not going to have to go into options and all that kind of stuff. Variable Universal Life, although sounding scarier, it's a lot simpler to explain. Variable Universal Life, as just like any other universal life, is a life insurance policy, which means if you die, it pays a death benefit. Now, the extra benefits to a universal life, especially a variable universal life, is it is invested in the stock market, so all the money that you put in, a lot of it gets invested, and hopefully it grows into what they call cash value accumulation. So let's talk about how exactly this money grows. The variable in variable universal life, the great way to describe what variable means in this is more returns with more risk. You have a much higher return possibility with a variable universal life as opposed to an index universal life. This one has no caps. If the stock market rises like crazy, you get to ride along with that. If it drops like crazy, you can lose everything. So it's more returns and it's more risk. Risk and reward. It's a balanced relationship. Variable universal life is invested into what they call sub-accounts. You might hear the word sub-accounts. All that typically means is mutual funds. Almost every single variable universal life policy is going to be invested in sub-accounts, which are mutual funds. So if you don't know what mutual funds are, I'll have a video coming out exactly how mutual funds work. But basically, it's someone manages the investment for you, and they invest in lots of other things, typically with different indexes and different safe stock investments and all that kind of stuff, right? Now, variable universal life, one of the ways that it pays out a lot more than index universal life is because it pays dividends. So there's no caps, meaning you get to participate fully, and it pays dividends, which is basically extra money that different stock companies throw at you quarterly just for being a shareholder. So you do get paid dividends. Now, there are certain tax advantages with a variable universal life. So a lot of people are jumping on index universal life right now because it's a safer investment and it just follows the indexes. There's caps, they buy options, so they don't have to, they can have the downside protection. Well, variable doesn't have that, but what it does have is some tax advantages. Now, there's pros and cons to these tax advantages, so let's talk about what they mean when they talk about this. When they're talking about tax advantages with a variable universal life, a lot of the times they'll be talking about when you actually withdraw your cash, you can withdraw it tax-free, or you can withdraw your money for free. That's kind of true and kind of not true, right? So the tax advantages that they're talking about is when you withdraw your cash value while you're still alive from your policy, because you can do that. You can take your cash value from it. Now, not a withdrawal, but a loan. So if I take a loan from my cash, it's tax-free. If I withdraw it, it's tax. If I take a loan from my cash value that I made, so if I take a loan on my own money, if I get a loan on my own money that I'm pulling out of this variable universal life policy, they can do that, and they'll charge me an interest rate on it. Why would I want to do that? Well, the loan, if I take a loan out on my cash value, say there's $200,000 in cash value in my account, I can take a loan from that money. Say I take a loan of $100,000. That loan is tax-free. None of that goes to the IRS. I just take my $100,000 and I walk away, and I pay my interest rate on the loan. Now, the reason you might do this is because the dividends that you receive and the earnings you get, what they usually call your dividend yield, may be close to the interest rate, and at times it can be the same, meaning the interest rate that you're supposed to be paying on the loan is covered by the dividend yield that you're receiving from your investments, which basically means, in theory, that you're loaning your own money out for free and you don't have to pay it back, and it's all tax-free. The only negative side of this is that it lowers your cash value, obviously, because you borrowed it, and it lowers your death benefit. So the money so say you take out $100,000 from your cash value and you're using it throughout your retirement, and then you die. Well, if you had $200,000 face value for your life insurance policy and you never paid back the $100,000, it's just going to get deducted from your death benefit. So your beneficiary would just get a little bit less money. So be careful with borrowing your own money, because when people talk about the tax advantages and borrowing for free, a lot of times they're not bringing up COI, which is the cost of insurance. So if I'm a senior citizen and I have no income anymore and I'm borrowing money from my cash value policy, my variable universal life, a lot of the time the policy is written to where it increases your cost of insurance every year. And as you get older, say if I'm an 85-year-old guy, the cost of insurance is going to be very high because chances are I'm going to die very soon. So if I want to keep my policy, they already know they're going to end up paying out. So they're going to charge me a lot to keep my life insurance policy. A lot of the times, the COI, the cost of insurance, starts eating away at your cash value that you've accumulated over your life. Because if I bought in a variable universal life when I was young and it was cheap and it had my entire lifetime to grow, I might have a ton of money in my cash value accumulation. Well, a lot of that money will be eaten away from my cost of insurance. If my insurance is costing me like $50,000 a quarter, that's eating away at my cash value. Why would it cost that much? Because I'm really old and they know I'm going to die pretty soon. So that's going to be eating away at your cash value and your death benefit. So if you're an older person and you start borrowing your money, even though the interest rate and the dividend yield might be close to the same, so you feel like you're borrowing your money for free, be careful, because if you're borrowing too much, your COI is still eating at your cash value. So there may not be a whole lot left when you die, and there may not be a whole lot left while you're still alive. So you might be eating up your entire policy if you borrow too much money. So that's pretty much everything I wanted to cover. That's variable universal life in a nutshell. Is more returns but more risk. It's invested in mutual funds. It pays dividends. There are certain tax advantages when used properly, but just make sure it fits your risk profile. Don't be buying a variable universal life policy if you're an older person and you can't afford to take risks, because if you're young, you can take a lot of risks with your investments, because if you stay in the stock market for 60 years, it's going to go up and down. If it goes down, don't worry, you stay in it for another 10 years and it's right back up again. If you're 75 years old and you're just barely getting into stock investing, you're going to want to choose a little bit safer investments. You're not going to want to jump into something that's really volatile, high risk, high return. When you're younger, you may be able to. So just make sure it fits your risk profile. But other than that, that's variable universal life in a nutshell. It's a really hot product right now, and it's definitely worth checking out. Just talk to your financial advisor if it's right for you. That's all I have to say. Until next time, my name is Thomas Harkey, and thank you for watching.